Good evening, everyone. Thank you for joining me here today. I want to begin with a statement: I'm buying again. Those are not casual words. They represent belief. They represent conviction. They represent the understanding that in this moment, something meaningful is happening, and I want to be a part of it. The world is shifting beneath our feet. For decades, one system, one currency, one structure seemed permanent, immovable, inevitable. But nothing in economics or in history stays still forever. The same forces that drive innovation in technology are also redefining the foundation of global finance. And that's why today I want to talk about something crucial: resilience. Because those who rely on one system, one source of truth, one currency, will be the most exposed when change arrives. I've spent years studying cycles, how value moves, how markets evolve, and how confidence can evaporate in an instant. What becomes clear over and over again is that the concentration of trust is the greatest risk of all. We learned it in the tech bubble, in the housing crash, in the banking crisis that seemed impossible until they were suddenly everywhere. And yet, time and again, we return to the same assumption, that one structure can bear all our faith. The world's monetary system has long been built on a single dominant framework. It has shaped trade policy and the flow of capital for generations. But now the digital economy, decentralized systems, and emerging markets are testing that dominance in real time. We are witnessing the democratization of value, the ability for people, companies, and even nations to transact, store, and exchange outside the traditional rails. This isn't rebellion, it's evolution. When I look at innovation across blockchain, digital wallets, artificial intelligence, and cross-border fintech infrastructure, I see something extraordinary: the birth of financial pluralism. Multiple systems coexisting, value moving freely, transparently, and instantaneously. This doesn't mean the old order vanishes overnight. It means it adapts or fades. And history tells us that adaptation favors those who see the signals early. Think about what happens when innovation challenges a monopoly. At first, it's dismissed. Then, it's ridiculed. Finally, it's inevitable. The same trajectory that defined the rise of streaming over cable, electric vehicles over combustion, or online retail over brick and mortar is now unfolding in finance. And just like in those industries, those who cling to the old model, those who rely solely on one way of doing things, often get left behind. This is not just about currency. It's about independence. It's about diversification of thought, capital, and access. For the first time in history, individuals can hold assets that aren't bound by borders or intermediaries. They can invest, transfer, and store value with transparency and efficiency unimaginable a decade ago. This is empowerment on a global scale. But with empowerment comes responsibility. We must understand what we own, why we own it, and how it fits into a changing ecosystem. The goal is not to abandon one system entirely. It's to recognize that no single system should define our future. Those who understand that truth will thrive in volatility, not fear it. The era ahead will reward agility. Governments will adapt, institutions will evolve, investors will recalibrate. But individuals who prepare now will navigate that transition with confidence. Don't assume that what has always worked will keep working. Don't assume that the currency you hold today will hold the same purchasing power tomorrow. The data, the trends, and the global sentiment all point in one direction. Diversification of value is not a hedge anymore. It's a necessity. I'm not advocating speculation. I'm advocating awareness. The world's next financial architecture will not be built by central banks alone. It will be shaped by entrepreneurs, technologists, and innovators rewriting the rules of exchange. They are building systems where transparency replaces trust and code replaces control. There's an irony here. Many fear this change because it challenges the familiar. But history's great leaps always begin with discomfort. The telephone disrupted communication, the internet disrupted information, digital finance will disrupt value itself. And when it does, those who relied on one currency, one system, one authority will find themselves waiting for a stability that no longer exists. So when I say, don't rely on one currency, I mean something deeper. Don't rely on one belief. Don't rely on a single institution to define your financial future. The world is too interconnected, too dynamic, too fast moving to place all your trust in one basket. Build exposure to real innovation, to tangible assets, to new ecosystems that are rising quietly but rapidly. The future doesn't belong to those who wait for certainty. It belongs to those who see transformation as opportunity. Money, like technology, evolves. And just as we wouldn't cling to outdated devices, we shouldn't cling to outdated systems of value. The next decade will redefine what safe means. And those who understand that shift now won't just protect their wealth, they'll help shape the foundation of the new economy. Because resilience isn't built on reliance. It's built on readiness. In every era of change, there's a moment when people begin to realize that paper promises, digital illusions, and abstract assets are not the same as ownership. We live in a time when screens flash numbers that represent value, but value itself has drifted far from what is tangible. That's why I believe the next phase of financial evolution will come from one simple principle: own real things. What does that mean in a world so heavily digitized, where wealth exists mostly as code in databases? It means holding something that the world needs, not just something the world trades. It means aligning capital with reality, not just speculation. Innovation doesn't invalidate the physical world, it enhances it. Every breakthrough, from energy storage to robotics to artificial intelligence, is built on tangible resources, infrastructure, and intellectual property that drive real impact. Those are real things. I've watched cycles rise and fall, waves of euphoria followed by waves of doubt. The common thread across history is that, in the end, ownership matters. When inflation erodes purchasing power, when currencies fluctuate, when markets correct, the question becomes, what do you actually own? What will endure when the mood shifts and the noise fades? Those who own real things, productive assets, technology, energy, land, innovation, hold something more enduring than sentiment. They hold substance. For decades, the financial world rewarded leverage and abstraction. Derivatives built on derivatives, promises built on promises. But abstraction is fragile. It thrives on confidence, and confidence can disappear overnight. The new world being built, the one powered by digitization, decentralization, and exponential technology, demands something different: credibility backed by reality. When I talk about owning real things, I'm not only talking about commodities or real estate. I'm talking about ownership in the engines of transformation. Equity in companies that produce, invent, and disrupt, intellectual property that shapes the next industrial wave, energy systems that power the future sustainably, data networks that underpin intelligence. These are the new, real assets, built not from scarcity but from innovation. Real ownership means exposure to productivity, not price. It means investing in assets that solve problems, not just chase momentum. The most successful investors in history understood this intuitively. They owned factories, patents, land, and infrastructure, things that created value whether markets were up or down. In a world that trades in volatility, these are the anchors that hold firm. Technology has given us incredible tools: instant trading, algorithmic precision, decentralized access, but it has also made it easier to lose touch with fundamentals. We can trade faster than ever, but are we owning better? Are we aligning our capital with the future we believe in, or just reacting to headlines and charts? True ownership requires conviction, patience, and understanding. It's not about timing the next move, it's about believing in the next era. Innovation itself is a real thing. It is not imaginary. It is built, engineered, tested, and deployed. When you invest in transformative innovation, you are not buying hype. You are buying the scaffolding of the future. Whether that's breakthroughs in energy, genomics, robotics, or AI, these are the physical and intellectual assets that will define growth in the decades ahead. We are entering a phase where scarcity will shift, not scarcity of resources, but scarcity of trust. And in that world, owning real things becomes a shield. When digital illusions crumble, tangible progress remains. It's the difference between owning a company that creates solutions and holding a token that represents speculation. Between owning innovation and renting sentiment. Throughout history, crises have reminded us what's real. When economies contract, what endures are the things that meet needs. Food, energy, technology, shelter, data, and human creativity. These are the building blocks of civilization, and they are also the foundation of future wealth. That's why I see this period not as a time to retreat, but to realign, to move away from passive exposure and toward purposeful ownership. The beauty of this moment is that real ownership is more accessible than ever. You can own a share in a company shaping the world. You can participate in networks that decentralize value creation. You can back innovators who are rebuilding systems from the ground up. Ownership has become democratized, but the principle remains timeless: hold what has substance, not just appearance. As we stand on the edge of a new economic cycle, the choice is clear: chase the temporary or build with the permanent. The coming transformation will reward those who understand what it means to truly own, to have a stake in something that creates, not just consumes. Owning real things is not a defensive act, it's visionary. It's a statement that you believe in progress, in the tangible outcomes of human ingenuity. It's how you participate in the next era of growth, not as a spectator, but as a builder. Because when everything digital becomes uncertain, when the noise overwhelms, when volatility tests conviction, real things will remain, and those who own them won't just preserve value, they'll shape the future. Every generation of investors faces a moment when the illusion of certainty dissolves. We believe we understand the system, the cycles, the correlations, and then something shifts, unexpectedly, sharply, and we are reminded that the world doesn't move in straight lines. In those moments, diversification stops being a cliché and becomes a lifeline. It's not just a strategy for managing risk, it's a philosophy of survival in a world defined by change. Diversification is protection, not from loss but from blindness. When markets move together, when fear dominates headlines, it's easy to forget that opportunity rarely lives where everyone is looking. True diversification isn't about owning many things that behave the same way. It's about holding conviction across ideas that move differently, that respond differently, that are built on different assumptions about the future. It's not about quantity, it's about diversity of thought. We are living through one of the most profound transitions in economic history. Entire industries are being rewritten by technology. Energy, finance, healthcare, manufacturing, all are undergoing transformations driven by data, automation, and artificial intelligence. The challenge is that these revolutions rarely unfold evenly. Innovation surges in one sector while another stagnates. Those who diversify across innovation, across timelines, across sectors of exponential change, are the ones who capture the upside without being destroyed by volatility. When I look at portfolios built on single themes, single assets, or single currencies, I see fragility. They can rise spectacularly, but they can also crumble under the weight of unexpected shifts. Diversification is not an admission of uncertainty, it's a recognition of complexity. The world is too dynamic to rely on one narrative, one market, one geography. Protection comes not from avoiding risk, but from spreading exposure intelligently across the forces shaping tomorrow. There's a misconception that diversification dilutes conviction. It doesn't, it refines it. It says, I believe in multiple dimensions of progress. It says, I see not one future but many possibilities. That's what protection looks like in a nonlinear world. When innovation collides with macroeconomics, when cycles overlap, when policy changes ripple through markets, diversification ensures you're not caught in a single current. Think of it like a biological system. A monoculture, where only one crop grows, may thrive for a season, but it's vulnerable to a single pest or a single drought. An ecosystem, on the other hand, survives disruption because its diversity sustains balance. The same principle applies to investing. When you hold exposure across sectors of genuine innovation, AI, energy storage, genomics, robotics, digital finance, you're not just spreading risk, you're participating in an ecosystem of progress. Some parts will grow faster than others, but together they form a resilient whole. Diversification is not about avoiding conviction, it's about scaling it. It allows you to express your belief in innovation, but through multiple lenses. You can be early in one space and late in another, aggressive in one theme and cautious in another, but together they reinforce each other. Protection doesn't mean hiding from volatility. It means designing resilience into your exposure. What's dangerous today is that too many portfolios still reflect the past. They're diversified across legacy industries, not across innovation. They hold exposure to assets that are highly correlated to old world growth, while ignoring the platforms that will define new world value. That's not protection, it's inertia. Real protection comes from diversification across the next era of disruption, where the drivers of growth are fundamentally different from what we knew. We've learned this lesson repeatedly. In every market downturn, the assets most concentrated around one narrative fall the hardest. In every rebound, the recovery comes from unexpected corners. Protection isn't just about surviving the storm, it's about positioning for the sunlight that follows. Those who diversify across time horizons, balancing the near term with the transformational, emerge not only intact but ahead. We are entering an era of exponential convergence, where technologies amplify each other's growth. That means diversification has to evolve too. It's not enough to spread across sectors, you must spread across platforms of innovation. When energy meets AI, when robotics meets biotech, when blockchain meets global finance, entire new markets are born. That's where diversification becomes opportunity. Protection doesn't come from playing it safe, it comes from understanding how change compounds. Diversify not to avoid loss, but to capture the future. Because the future won't move in a straight line. It will move in waves, in bursts, in exponential leaps. If you're anchored to only one theme, one idea, one market, you risk missing the very transformation you're waiting for. In times of uncertainty, fear pushes people toward simplicity, toward the illusion that one asset, one currency, one hedge will keep them safe. But simplicity in complex times is dangerous. The world is evolving too quickly for narrow thinking. The antidote isn't panic, it's preparation. Diversification is how you participate in change without being consumed by it. So, when I say diversification is protection, I mean this. It's how you stay in the game when the rules keep changing. It's how you convert volatility into opportunity. It's how you ensure that no single failure defines your future. The world doesn't reward those who cling to one idea. It rewards those who adapt. And adaptation begins with diversification. Because in the end, the strongest portfolios, like the strongest ecosystems, are built not on certainty but on balance. Every generation believes the present moment is permanent, that the current direction of markets, politics, and technology will simply continue. But history tells a different story. The world doesn't move in a straight line, it moves in cycles. Expansion and contraction, optimism and fear, innovation and resistance. Each wave sets the stage for the next. Those who think long-term understand that progress isn't a sprint, it's a rhythm. And the investors who learn to hear that rhythm aren't reacting to every noise. They're anticipating what comes next. When I look at markets, I don't see chaos. I see phases. Times of excess followed by correction. Moments when optimism blinds us to risk, followed by moments when fear blinds us to opportunity. Long-term thinking requires stepping back, seeing not just the chart on the screen, but the pattern underneath it. Every disruption, every downturn, every breakthrough fits into a larger cycle of transformation. We're living in an age where short-term noise dominates. Every day brings a new headline, a new data point, a new emotional trigger. Algorithms react in microseconds, investors in minutes. But the great shifts, the ones that redefine economies and societies, unfold over years, sometimes decades. Thinking in long-term cycles means having the patience to let fundamental change take shape, even when sentiment is temporarily against it. The truth is, markets are emotional reflections of human behavior. We overestimate what can happen in a year and underestimate what can happen in 10. That's why cycles exist. Innovation takes time to compound, adoption takes time to spread, and confidence takes time to rebuild after fear. When you understand that, volatility stops feeling like a threat and starts feeling like opportunity. Every major innovation wave in history has followed the same pattern: discovery, skepticism, adoption, and finally, transformation. The steam engine, electricity, the internet all began with disbelief. And yet, each cycle lifted productivity, changed industries, and created new wealth. Today's technologies, artificial intelligence, robotics, genomics, energy storage, digital finance, are following the same path. Early volatility doesn't mean failure, it's the natural rhythm of progress. Thinking long-term doesn't mean ignoring the present, it means interpreting it correctly. Short-term pain often precedes long-term gain. When innovation challenges legacy systems, resistance is inevitable. But each downturn clears inefficiencies, each correction resets expectations, and each recovery starts from a stronger foundation. Those who understand cycles see corrections not as endings but as transitions. The mistake most investors make is linear thinking. We assume that what has been rising will keep rising, and what has been falling will keep falling. But cycles are circular. Excess always breeds adjustment, and pessimism always breeds opportunity. The art of long-term investing lies in positioning yourself not where the crowd is today, but where value will emerge tomorrow. That's impossible without a cyclical mindset. If we zoom out far enough, we notice how innovation drives the longest cycles of all, the generational ones. The agricultural revolution, the industrial revolution, the digital revolution, each created entirely new economic realities. Today we are on the verge of another revolution, the convergence of technologies accelerating at exponential rates. It will reshape industries, redistribute wealth, and redefine productivity. But these changes will not play out in weeks or months. They'll evolve through cycles of doubt, experimentation, and eventual acceptance. The market doesn't reward impatience. It rewards conviction sustained through volatility. Thinking in long-term cycles gives you that conviction. You stop trying to time perfection and start trusting progression. You understand that breakthroughs rarely announce themselves in calm markets. They emerge when uncertainty is highest. That's why cyclical awareness is not just a financial principle, it's a mindset of resilience. Right now, we're at a fascinating inflection point. The world is recalibrating from decades of easy money, rethinking globalization, and adapting to rapid technological convergence. It feels uncomfortable because we're in the middle of a shift, but history tells us that such discomfort often precedes acceleration. When capital reallocates toward innovation, productivity soars, and the next growth cycle begins. The question is, who's willing to hold through the noise to capture that moment? To think in long-term cycles is to understand that patience is not passive, it's strategic. It's knowing that conviction doesn't mean you'll be right immediately, it means you'll be right eventually. The future rewards those who keep investing when others hesitate, who keep learning when others lose faith, who keep building when others stop believing. That's how new cycles begin, quietly against consensus. The greatest opportunities often emerge in the troughs of the cycle, when sentiment is lowest and vision is scarce. That's when real innovation accelerates, because necessity fuels invention. It's when long-term thinkers plant the seeds that short-term traders later chase. So when I say think long-term cycles, I mean zoom out. See the bigger rhythm of progress. The present may look volatile, even chaotic, but underneath the noise, innovation is compounding. Patterns are repeating. History is rhyming. If you can see that, if you can hold through the cycle, you won't just survive transitions, you'll help lead them. Because time, in the end, is the most powerful investment edge. Those who think in cycles, not moments, don't just predict the future, they build it.